Hello and welcome to a new episode of Majlis and Markets with your host Hassan Jivraj. In this podcast, we aim to bring you thought provoking conversations with influential leaders in Islamic and global markets. In today's episode, we're delving into the world of ESG, climate finance, and Islamic finance. Over the past decade, the financial world has undergone a notable transformation, marked by the substantial rise of environmental, social, and governance principles and socially responsible investing. This surge has not only reshaped the financial landscape, but has also brought integrating ethical considerations into investment strategies to the forefront. Similarly, within the framework of Islamic finance, Sharia principles guide investment decisions. However, whilst there are similarities between these forms of finance, what are their differences, and how are these forms of financing helping Muslim countries meet their climate commitments? And are they having a real impact, or are they just labels like green or faith washing? My guest today is someone who can help us understand this more. Blake Goud is the CEO of RFI Foundation, a position he has held since 2015. RFI's mission is to enable financial players in OIC markets and the Islamic finance industry to deliver sustainable values through research, training, and implementation programs. During our conversation, I spoke to Blake about several topics, including the origins and the rise of ESG, the role of green sukuk, and climate risks facing OIC countries. Blake Gould, welcome to Majlis and Markets. Good to have you here.
Thanks for inviting me.
Blake, you've got a really interesting history, interesting background, and your job is like really interesting. Could you maybe tell us a little bit about yourself and what you do at RFI?
Sure. So my background is from Islamic finance field that I got interested in and started working in back in 2006. And so when RFI was set up, it was kind of a return to what initially drew me to Islamic finance, which was that kind of connection between responsible investment and Islamic finance that had gotten my interest back. I guess it's almost 20 years now. And RFI was really set up to promote that convergence of at the time when RFI was set up, there wasn't much engagement between responsible finance and Islamic finance. And so we were created to build that. And then as time has progressed and we've seen a lot more interest in ESG in Islamic markets and in Islamic finance, we've been focusing more and more on what are some of the challenges that financial institutions in OIC markets are facing when it comes to actually putting these concepts into practice, going beyond kind of just the building awareness of why they should be doing it and focusing more on how.
Yeah, I just I remember when we first met in 2013 at I think it was at the Global Islamic Economy Summit in Dubai. Um, and I remember you talking at that time about ESG, and I think ESG at that time wasn't really much of a buzzword as it is today. And ESG, just for our listeners, is environmental, social, and governance. Could you maybe kind of tell us a little bit about what ESG is and where it comes from and how it's developed in the OIC countries?
Yeah, so I think where it's developed kind of as the outgrowth of socially responsible investing, even though they're different concepts. So socially responsible investing is kind of values aligned regardless of the cost. And ESG is trying to broaden the acceptability and the applicability by focusing on things that are financially material that have a connection to environmental, social, or governance impacts. And so it aligns with trends in corporate governance, promoting good corporate governance, and then also the environment side has a lot of focus on the cost of not being not protecting the environment in the way that companies operate comes back with financial repercussions. And then there's also things the social tends to focus a lot on labor rights, discrimination. So there are things that have impact from an environmental, social, or governance angle, but it's always viewed through that financial dimension.
And this originated where, in America, or did it originate somewhere else, or do you think it started in the US with Wall Street, or?
It started in the early 2000s. I think the you can trace back to a report that the UN put out called "Who Cares Wins," that was really trying to speak about environmental and social issues in the language of that Wall Street and the companies would understand. And this is a time when there was a lot of advocacy around environmental and social issues. I remember I was living in Portland in college at the time when the protests against the WTO
The World Trade
got
Organization.
the happened in Seattle. Um, and so it's a few years after that, it's how are some of the same efforts being undertaken to get environmental and social consideration into the way that companies are doing business and the way that investors are making investments.
And why do you think the UN decided to focus on the financial sector? Why particularly that sector? There doesn't seem to be a really big connect. Is there a big connection between, like, say, environment and finance, or social governance, social issues and finance? Would you say?
Well, I think it was moving in finance in parallel with push on companies. And so the UN Global Compact was formed to embed the UN treaties and agreements into practice on from a corporate side. And the thing that companies run on is money, whether that's equity, capital, loans, bonds. And so it was only, I think, only natural that you would extend into the dimension of the financial sector, because if companies are not being either incentivized or punished for doing things poorly, uh, then it falls back to is there enough um, regulatory enforcement capacity to deal with all the impacts, or are there other actors that can play that kind of market discipline role, where the financial sector, I think, plays a big role. If it's financially material, then it matters to investors, and they are kind of filling the gaps where regulatory enforcement either is absent or is just under had too little capacity to deal with all of the issues that are out there.
Yeah. Do you think it just really took off in like 2008 with the global financial crisis? I think people started to take more notice of things like the environment and social issues. And then I guess in the last, say, 10 years, it's probably become even more of an issue, right? Or like, excuse the pun, but it's become more of a talking point amongst people in the financial community.
Yeah, so the Principles for Responsible Investment, there was initiative involving the UN supported it, and it came out of the Global Compact, focused on asset owners. That was really that started up right before the financial crisis, but it really got a boost after the financial crisis, and people saw the consequences of ignoring things that you could tell were not right, but didn't show up in the short-term financial statements of companies.
Right. So you're saying it's going beyond the bottom line, beyond net profit of a company or a
Well,
organization.
financial statements are backwards looking, and ESG is trying to be forwards looking at what are the things that could appear in the financial statements tomorrow or next year or 5 years from now, um, because of the way that the company is behaving today. And those they're called non-financial data, but it always, when you're talking about ESG, is rooted in ESG information that has some financial consequence, even if that financial consequence hasn't been realized yet.
But my question is, why do you think people have started to talk about this a lot more? Or why has it become like a really mainstream thing? Like, I mean, when you were talking about this in 2013, most people weren't
Mhm.
talking about ESG. Um, why do you think all of a sudden it's happened, or like it's happened over the last 5 or 6 years?
Well, I think a big part of it is that we're seeing the physical consequences of climate change,
Mhm.
and the increased frequency and severity of storms tends to be something that you can't ignore it, and so other things start popping up, and some of the financial impacts of companies not behaving well, whether it's the Volkswagen emissions cheating scandal or the Deepwater Horizon. I mean, those have been typically the ones pointed to in the earlier years as I think BP lost $40 billion wiped off their market cap when their well exploded. And it wasn't an isolated thing. They had safety lapses preceding that. That that's the point is cases where that theory of there are things the company's doing that aren't on its financial statements today that will have impact on the financial statements or valuation of companies in the future. And events like that kind of made it real because they were, I guess, what 10 digit 11 digit impact on the bottom
Right.
line.
And another thing related to ESG, we'll come back to ESG in a second, but another thing you're interested in is something called SRI. What is SRI?
Socially responsible investing is kind of the predecessor to ESG, and it was people incorporating values into financial decisions. And again, it was kind of without necessarily having the consequence of caring if it was the most profitable thing to do. It was just, I think these are unethical activities, and I don't want to support them with my money. And I think that's where Islamic finance was interesting to me, was the overlap of that. SRI tends to focus just on investments. Islamic finance took the view that ethical constraints should apply to banking, to insurance, to investments, to kind of every aspect of the financial sector.
Yeah. So would you say Islamic finance and ESG and SRI are they interconnected, or are they the same thing, or do you think there are differences between all three of them? Or
I think they overlap at points. SRI and Islamic finance traditionally have had more overlap with each other than either of them do with ESG. ESG tends to be something that can be applied and has some points of consistency with Islamic finance and SRI, but they're not the same thing, and they don't have the same objectives.
right?
At
Can you give us
least
an
in their
example? Can you give us an example of how they're different?
well, I think like a big difference would be if you're investing in, it's been something that's popped up recently as a controversy, is the role of investors, and should they be financing weapons producers, firearms manufacturers, and SRI and Islamic finance would say no. Those are unethical, socially detrimental sectors that shouldn't be financed. And ESG would say possibly, and it depends on how well they're managing the negative externalities that could come back in the form of something like product liability for firearms manufacturers.
So are you saying like they cover different areas, but not all areas? So for example, ESG would, you know, say something is okay as long as like it fulfills some sort of criteria, whereas Islamic finance or SRI is a lot more stringent, would you say? Or would you say it depends case by case?
Generally, ESG doesn't come with an ethical lens to decide if something's right or wrong. It comes with that financial lens, which says, is this something um, that's profitable, considering all of the different things that could impact it today and into the future. Whereas SRI and Islamic finance come down much more strongly on, is this something that's ethical or not, and base decisions on whether or not it meets those criteria. And those criteria have lots of overlaps. Lots of SRI investors will screen out companies involved in alcohol and gambling, in weapons. And Islamic
But
finance will have kind of some additional ones, excluding pork
yeah,
producers and conventional finance. But I think from the methodology of how it's decided and implemented, they're much more in common with each other than they are with ESG. Although, yeah, again, it's kind of, there's compatibility to use them both together. And
right,
often you'll with ethical funds, you'll see them doing both, having the ethical screens and the ESG considerations. So it's
right.
not kind of either or, but there are people that are not investing for ethical reasons that are using ESG.
Right. And with ESG, one thing I wanted to ask you, um, it seems to me like a lot of it's been focusing on the E part of everything.
Mhm.
Not much really given, emphasis towards S and G. Why is that?
Well, I think a lot of the G factors get, and particularly the ones that get measured, and particularly in developed markets where a lot of ESG is happening, those are embedded in legislation, and regulation. So there's less of a kind of additionality that ESG is playing a role in. I mean, there's been long-standing movements to improve corporate governance, and that probably takes over a lot of the bulk of the work. But then it's through listing requirements, through exchanges that'll set governance requirements that'll tackle that G, and then uh, it's kind of from an investor perspective, do they see that there's something missing, a gap that they need to kind of carry over from their own, uh, whether it's from their own home market, that they want to compare foreign companies as if they were under that what the governance framework they're used to. So that's, I think, on G. With S, I think it was last year we saw the European Union's efforts to create a social taxonomy get put on hold.
What's a taxonomy? Just for our listeners, what's a
Taxonomy
taxonomy?
is a list of things of kind of agreed upon thresholds of,
Right. It's like a set of standards, basically.
yeah. And so they have done one for environment. So they're defining what is green, what is the threshold for something to be considered green, and they were trying to do the same analogous taxonomy for social.
Mm.
What is good enough look like in the social dimension, and they couldn't come to an agreement on it. And speaking, comparing the European Union to the world as a whole, um, it's a lot more homogenous in terms of defining that, and yet still there were such a wide variety of views that they couldn't come to a kind of baseline of, we all agree that these things are the thresholds for something to be good or not good, on the S dimension. And so in the global sphere, I mean, you just multiply that challenge, and so it ends up, that it becomes much more difficult to come up with agreed upon standards, and it's also a little bit harder to measure quantitatively. S factors, like you can measure emissions of carbon dioxide in terms of tons of CO2 equivalent, but you don't have that in terms of uh, uh, companies and their labor
She's saying it's more qualitative than
relationships.
quantitative.
It's more qualitative, or the quantitative parts that you can measure don't necessarily, you can't directly, there's not a price on those. You can't, it's harder to put a financial price on those like you do with, you can look at a carbon market and say the European trading scheme, for the emissions trading scheme, is pricing carbon at $40 a ton or 40 euros a ton.
Mm.
There's not an equivalent translation kind of between the data that you're capturing on the impact and the financial implications that you can use, even if it's using as a proxy, like an internal carbon price. There's not an equivalent in the social sphere.
Right, right. With regards to climate risks in OIC countries, um, how can ESG, SRI, and Islamic finance play a role? Obviously, we've seen the role of Islamic finance and ESG Sukuk. So, um, since 2018, ESG Sukuk has increased a lot. I think I read a report by Fitch, which only gave up till October 2023, and it said about 33 billion has been issued of ESG linked Sukuk. So it's basically Sukuk, which are Islamic debt instruments with an ESG angle to them. And Fitch believes that 7.5% of Sukuk will be ESG compliant by 2028. Still very small, but how would you say Islamic or ESG Islamic finance instruments are helping OIC countries mitigate some of their climate risks?
But I think it's been a bit more challenging for that market to grow the same way that the labeled bond issuance has grown, particularly in developed markets, and green bonds in particular. Green bonds, yeah, I think they 1 year they reached $1 trillion of issuance from a pretty small base just in the last like 5 years. And I think the challenge is that when you're looking at what is needed on the investment side in OIC countries, it's different. There's not kind of a long list of green eligible projects that you could just uh, issue sukuk to fund the same way there is in developed countries. And so I think there hasn't been as much of a development of the standards around transition finance in particular until
What is transition finance?
transition finance is the finance that's required for companies to align themselves on the trajectory that is Paris aligned,
So you're
Paris
talking about
agreement aligned.
the UN Paris climate look, or the COP that was held in Paris in 2015. Is that what you're referring to?
Yeah. So maintaining global temperatures of well under 2 degrees centigrade
Right.
increase over pre-industrial levels, or with the ambition towards 1.5 degrees. Um, and so there's a lot of finance that's going to be needed uh, to get from where we are today to where to being aligned and with net zero 2050, which is part of it. But there's also part of how quickly does that transition need to happen in terms of emissions reductions have to be front loaded. But the path for what you need to invest in is different in developed markets than in emerging markets. Developed markets just need to focus on less fossil fuels, more renewables as
Right.
quickly as possible. Um, there's kind of a more nuanced take, I think, in emerging markets of there's clearly going to be some need for increased investment in renewables and transition away from fossil fuels the way that the Paris or that the COP28 declaration settled on. Um, but it's they tend to carry less um, other than China in particular. Most emerging markets are small historical contributors to uh, global emissions, and because what we're focused on is not the year over year emissions, but the total CO2 concentrations in the air. That's what's creating the impacts of climate change. And if you look at the who's responsible for most of those, it tends to be developed markets plus China. And
Right.
plus China over the last 20 years.
What about the likes of say Saudi Aramco or ADNOC or the one in Malaysia,
Petronas.
Petronas? These kind of companies, you don't think they have some responsibility in emission as well?
Well, they do, but largely the benefits of the release of those emissions have accrued to the demand side. Um, and so, yeah, there's one thing to say the total value of all the oil produced and consumed globally since 1850 is X amount, and Saudi Aramco accounts for that percentage, and Petronas accounts for that percentage, and Shell accounts for that percentage, and Exxon accounts for that percentage. But that's the kind of crude commodity earnings from it. But think about kind of the economic activity that has been created as a result of burning that fossil fuel and emitting that GHG.
GHG is greenhouse gas emission, right?
Yeah, greenhouse gas emissions. I think that's largely where uh, the demand side is what's causing the oil to be pulled out of the ground in the first place.
Right.
And so until you change the demand patterns and the sources of how their demand, if we have a fossil fuel, an internal combustion engine in a car, you can't plug that into the wall and power it with electricity. You need a new car to change your demand patterns. And so that's happening. I think I saw a chart the other day that was showing that internal combustion engine sales on a global level peaked in 2017. They've declined every year since
Mm.
then, and electric vehicles have increased every year since then. So that kind of those assets are changing the demand patterns for fossil fuels, for oil in particular, uh, and that drives change on the supply side, um, much more than deciding one day that we need to transition away from fossil fuels. So we're going to tackle this primarily on the supply side. It doesn't, it's not as effective. Uh, the supply side will respond to the changes that happen on the demand side. And the
Right.
demand side changes in large part are you're talking about capital assets that, cars, factories, electricity generation stations.
So are you saying
Those,
that are you saying that BYD and Tesla and other EV manufacturers need to ramp up in OIC countries? Is that what you're saying?
but yeah, I think China has now become one of the largest exporters of cars
Mm.
in the world. And a lot of those are being produced are electric vehicles. And so that's I think yeah, when you're talking about the sources of demand, it's driven by the capital assets, and that's also a reason why the financial sector is so important. Is that the decisions that finance is making today will lock in the lifespan of whatever assets are being financed for a long period or a short period, kind of depending on the trajectory of the transition. The transition will depend will you could shorten the lifespan of high emitting assets, to strand them, to make them stranded assets,
Right.
um, depending on the speed. And I think that's the decision that's being made today is where do we invest knowing that there's going to be stranding of some assets if we go along a fast enough pace.
Right.
And so finance has taken that account and can't just say, I'm building this new coal-fired power plant, and I know that technically it will last for 50 years. If there's no grid that wants to take the power generated from that, or if the economics assume a zero price on the GHG emissions from that plant, and that changes to $200 a ton 10 years from now, that's going to dramatically change the economics of that asset, which
Mm.
then for anyone who's a bank that's financed it or bonds that have been issued for its construction, the repayment ability is going to be impacted. And so we're trying to figure out these things today based on what whole range of things that might happen in the future, depending on the speed of the climate transition. And that's hard, and it's kind of it's an ESG thing, but has a longer future that you have to incorporate today, and more significant consequences if it doesn't happen at the speed it needs to.
Right. With regards to ESG and SRI in OIC countries, which countries do you think are leading the way in this initiative or these initiatives rather? Like Malaysia, Indonesia. I think the first ever green sukuk was sold in Malaysia, I want to say, or was it Indonesia? I can't
Yeah,
remember.
I think it was 2017,
Yeah,
the solar sukuk.
and then Indonesia's issued in the international market green sukuk, and I think other
Yeah,
countries like in the GCC, the Gulf Cooperation Council countries have issued green bonds and green sukuk and done a lot of green financing or sustainable financing. I'm just curious to get your thoughts on these things which are called green and sustainable. How green are they and how sustainable are they? Are they really helping these countries, decarbonize and become more renewable focused?
well, I think they are, but it's not always kind of direct impact. because a lot of the progression of green finance has involved tagging things that are already happening and labeling them as green, so that there's to try to create a differential in pricing, between the green activities that are labeled and all the other activities, whether they're green or not. Is if it's an undifferentiated mix, then it's kind of there's no pricing advantage. There's no pricing advantage from being better prepared for the transition. And if you have something that's labeled green and is a renewable energy facility, or a green building that has reasons built into it of why it's going to be better suited for the transition, um, then that can start to attract more funding. But it doesn't necessarily happen overnight. It's a process of trying to create that, a little bit of that wedge, the
Because what
pricing wedge.
something like, for example, if we look at Indonesia, it's, huge palm oil producer. It has other um, sectors which are not environmentally friendly, and it relies on that for its GDP and economic activity. And with them issuing green bonds or green sukuk or doing kind of ESG linked financing, I mean, I was when Indonesia did their first international green sukuk, I was talking to one of the lawyers who, um, he had good knowledge of how it was structured because it was the first time they were doing it, and he basically said to me like, the proceeds have to be green, but the way you get the financing doesn't, like, that the issuer doesn't have to, have like really strong green credentials, as long as it shows where the proceeds are going to the investors. That's
Mhm.
all they care about, really. It doesn't really have much material impact.
Well, I think that's where it's the kind of direct versus indirect impact from it. Like directly, often it's things that are already being financed, that are being labeled as green, uh, and that kind of you're sort of building the size of those assets within the overall economy to attract more funding towards the green activities, to create a signal that that's where the better long-term returns are to be found, to pull capital. But that
Is it just
doesn't.
not marketing? You don't think this is just all marketing at the end of the day? Rather, you said like about labeling. So aren't these just labels to attract new capital into new assets, or just transfer of assets of capital to another asset
Well,
class?
it's labeling, but it's done because the label conveys some useful information that has some financial implication. I think there's I think the labeled green issuance has a much stronger case for uh, providing something that's useful information in terms of being backed up by a specific requirement for it has to meet this threshold to be classified as green. And you compare that to the sustainability linked financing, so whether it's bonds or loans or Islamic financing, but where the funds are going to an issuer and the issuer is saying we're going to improve on these metrics with these KPIs over this set period by X amount, or else we're going to pay a penalty of 20 basis points on the yield. There was Those had much more problematic elements. Some of them had the ability for the issuer to refinance it, and avoid the penalty, um, which clearly weakens the incentive. I saw one that was, I think it was a asset manager that issued a bond that was focused on gender diversity, and the penalty for not making it was 1 basis point, which also doesn't send a very strong signal. Uh, I think some of the, like, even kind of utilities that have issued, they'll maybe pay 25 basis point if they don't make the target, but they're getting a pricing benefit on issuance that's greater than that potential penalty. So they've already baked in the gain, and it's only a question of whether they're going to give up a part of the gain compared to a vanilla issuance. So I think
And
that's,
vanilla issuance. Sorry, I didn't mean to cut you off, but
oh, yeah.
issuance is just a normal issuance, right?
Yeah, just a normal bond that doesn't
Right.
have sustainability KPIs.
Right. There was a transaction. I remember us talking about this in 2014. It was, I think, the World Bank, one of their arms or subsidiaries, did a deal about children immunization, the Sukuk. Um, it was a really landmark deal and an innovative deal, and I thought it was a really nice kind of way of linking Islamic finance with like social projects and delivering a return to investors in a Sharia compliant manner. Why do you think we have not seen these kind of deals happen in in the past 10 years?
Well, I think with that deal, the IFM Sukuk International Finance Facility for immunizations, really the mechanics behind it were very simple. There were pledges for immunization from uh, several countries that had high credit ratings, and you get more benefit if you do more immunizations today than if you wait 5 years. And so there was a real clear mechanics of you have these cash flows coming in over the next 5 or 20 years, uh, but you need the money now. And so pulling that forward to finance the immunizations was just a fairly simple transaction to do, and it was fairly easy, I think, uh, in this kook structuring
But don't you think that was a good example?
side.
That was a good example of how Islamic finance can have like a real impact.
Yeah, I think it was a great use for that because it showed how Sukuk was a flexible enough instrument to to be to be used in this situation um, that created a positive social impact. I think the challenge was that there aren't too many kind of uh, to use a baseball analogy, fat pitches that
Mhm.
come where you have AAA or AA rated sovereigns that have made making long-term pledges that you're just trying to pull the proceeds from forward. I think that was where it became you don't see too many of those come up necessarily, and so there just aren't as many opportunities. But Islamic finance, I think, showed that it's perfectly flexible enough to accommodate those types of situations.
Yeah, it just seems to me like a lot of sukuk are tied up in either sovereign issuances, the government of Saudi Arabia or the government of Malaysia or Indonesia or Turkey issuing sukuk to finance the budget deficit, or a real estate company in Qatar can issue sukuk, or in Dubai or wherever. But like a sukuk coming for like a real social impact, there doesn't seem to be that much. So Blake, when the IFM sukuk was really like a good example of like how Islamic finance and social impact can be linked together through sukuk issuance. Um, I remember back in 2014, I was having a conversation with a portfolio manager who really liked the IFM deal, and he liked the financial metrics, and he liked all the project impact that it had, and he took it to his investment committee. But they basically turned around and said, look, we're not a charity. We're more interested in, spread and just looking at the financial metrics rather than looking at, say, the social impact. Do you think like there's a lack of understanding within asset managers in adopting or subscribing to things like social impact sukuk?
There's definitely I think still probably a perception issue. It's narrowed over time. I think it's as it's become more understood that there's not necessarily a conflict there. Uh, there is a challenge in some cases in terms of a lot of the impact oriented issuance. It's hard to get it up to the same size of a bond or sukuk issuance. I think that's another point where the IFM sukuk had a kind of unique situation. And so, because from a structuring perspective, documentation, even the investor review side, there's more or less the same amount of work for a transaction, regardless of its size. And so, if you don't see too many sukuk outside of Malaysia in general that are under $100 million, often under $500 million. And I think that drives people see that that's kind of additional work, additional cost, and it just adds more and more barriers. And then when you're talking about evaluating the impact and the credibility and the impact with it, that's adding on kind of an additional requirement that makes it more difficult. It narrows the set of potential issuers who are able to tap the market.
I know the Islamic Development Bank has done, similar transactions, but they weren't as landmark as the IFM Sukuk back in 2014. Do you think like they need to do more? Other stakeholders within the industry, like for example, AOFI, the Accounting and Auditing of Islamic Financial Institutions, and the IFSB, Islamic Financial Services Board in Malaysia. Do you think everyone needs to do a little bit more in terms of prompting issuers and investors to try and think about these kind of issues?
Well, I think with the standard setting bodies, they have a specific role to play. And so RFI has been working with IOFI on the responsible finance standard. And then IFSB, it has the role of adapting the Basel Committee on Banking Supervision standards to Islamic finance. And so there's been quite a bit recently over the last year, particularly around climate risk from the BCBS. And you've seen that picked up by regulators in OIC countries like Bank Negara Malaysia and others. And so imagine that that we'll see kind of the guidance where it's needed for specific ways that Islamic finance will need to embed that. I think with development banks like the IDB, I think that it may not necessarily be something where they need to do more prompting for it. It may be just the case that over time there's greater understanding of the developmental impact or the climate impacts of the financing, and they've been quite active in both issuing particularly sustainability sukuk, but also they had a green sukuk, the euro denominated green sukuk issued a couple years ago. And so I think that's where they have lots of potential to raise funds. But I think going back to the point about the different characteristics of emerging markets and developing markets in the transition, the types of labeled issuance that would be most applicable to a bank, a multilateral that serves OIC countries, that serves largely emerging markets and developing countries, is only now starting to be developed. And until it does, you can put out kind of the labels, you can fit where the labels apply, and then you can provide more information on the developmental impact of different financing that's enabled by a sukuk, but it doesn't have the same kind of market pull the way that green has, because it has a dedicated source of investors who are looking specifically for that label.
Right. Earlier in the conversation, you mentioned about the principles of responsible investing and also the principles of responsible banking. These are both UN initiatives, if I'm not mistaken. And I think what they try and do, correct me if I'm wrong, that there are frameworks which try and help educate and try and facilitate banks and financial institutions to try and decarbonize or try and realign their portfolios and investments and lending book or lending activities rather, to try and make them more environmentally friendly and less environmentally hazardous. There are other international frameworks as well. But my question is, when you look at the data, for example, on adoption of Islamic financial institutions and indeed just general financial institutions in OIC countries, the adoption to me doesn't seem to have been taken up or been subscribed to by a lot of institutions. Why is that? Why are not many Islamic financial institutions not signing up to these frameworks?
Well, the PRI was set up in 2006, and it's about incorporating ESG into the investment framework, and then PRB is similar, so environmental, social, and governance consideration by banks, and that was set up in 2019, and RFI has been an endorser of the PRB since before it was launched. And I think the reason is because it's so important that ESG be applied across the whole financial sector. But it does take some effort for institutions to build the capacity to do that. And I think one of the things that's been particularly challenging for Islamic financial institutions and OIC financial institutions when it look at these frameworks is that part of what was built into the PRB when it was set up was the idea that if you don't have kind of time-bound commitments that come with joining an initiative like that, that it doesn't provide the impetus for as much internal change in the way that the institution works uh, as it could. And so PRB was set up with specific requirements for when signatories have to start reporting against the framework that's been developed by the PRB. And so I think that it makes it less easy to just sign up and go about your business, because if you sign up for something that has 18 months later you have to report, or 3 years you're to be on annual reporting, you have to plan to make sure that you can meet that objective before you sign up. And you've seen that the same kind of thing happening with the Science-Based Targets Initiative, where they have a process of making a science-based target, and then over time they've had to strengthen those requirements, and they've been delisting companies that made targets and haven't followed through on them. So I think the PRB was set up in a smart way to incentivize banks to join once they're ready to actually have a defined roadmap of 2 years, 3 years, that they're going to be much kind of stronger in the market in their credibility around their ESG approach if they prepare for that process before they sign up. But that also, I think, does create a barrier, and I think it creates more of a barrier for smaller institutions, and Islamic financial institutions tend to be smaller than conventional peers within the markets they operate.
Yeah. Would you also say that with Islamic banks in particular, because they have to be involved in Sharia compliant activities, so there has to, in most cases, there has to be a tangible asset. So say, for example, a piece of real estate or oil and gas, transport, something tangible, a tangible asset, which may or may not be environmentally friendly, or fitting the criteria of ESG. Would you say that's also a challenge particularly for Islamic banks?
I don't think so. I don't think that's the significant barrier. I think that in large part, that that may, there's additional already existing governance requirements they have to follow, that is one other thing that they're doing, that is absorbing some of their capacities. They may have less spare capacity, but I think because of the compatibility in kind of objectives, I think that can drive institutions to implement just fine. I think it's
So
making sure that they.
are you saying this is coming more from the shareholders and central banks, or from governments? Because like if you look at some of these Islamic banks in the world, in GCC or Malaysia or Indonesia, a lot of them indirectly or directly are owned by the government, or people or institutions connected to the government. So say for example in GCC countries, majority of these countries are oil producing countries. Oil still plays a massive role in countries like Saudi Arabia and Kuwait,
Mhm.
and the large Islamic financial institutions in these countries are owned by individuals or organizations connected to the governments. Do you think so? There's no impetus from them. Do you think like that's probably a reason why they're not adopting these frameworks?
Well, I think there has been a impetus from the government, and you saw that strongly in Malaysia, and then more recently in particularly like the UAE and Saudi Arabia with the adoption at the national level of net zero targets. And I think within Saudi Arabia, you've seen more activity in the public public sector banks than you have on the private sector banks. Um, but I think more the issue is that the frameworks of the PRB, for example, these are setting specific requirements, and if you look at the kind of Net Zero Banking Alliance or the other GFANZ alliances, they're setting specific requirements, and so I think it's good that banks are making sure that they're prepared before they sign on versus just signing on to have kind of that affiliation.
Mm.
And so I think that's kind of speaks to a little bit, I guess, a maturity in terms of making sure that you can walk the walk before you start talking the talk.
Yeah, it also seems to me that a lot of countries, like in the Gulf, are developing their own ESG frameworks and systems for their financial institutions. So obviously, like I mentioned, we've seen a large proliferation of ESG related sukuk and financial transactions, but they align more to say local taxonomies than say the PRB or like other international frameworks. Do you think that's a fair characterization?
Well, I think it comes down to the underlying economic characteristics of the economy and what its ESG challenges are, and then on the climate front, what is its transition plan and what is the uh, national strategy that often drives a lot of things. And I think what's been particularly useful to see happen, and it's really been driven in large part by the Monetary Authority of Singapore, is adding the traffic light taxonomy into the lexicon. So, kind of stepping back, we had the European Union's green taxonomy, which was the first major taxonomy to be released. Um, and it was kind of a bright green line that said if you're on this side of the line, you're green. If you're on that side of the line, you're not green. If you're not close to the line, don't even bother. You're unsustainable. Uh, and I think that creates a lot of problems. Not just within the structure of a taxonomy like that, because it puts so much pressure to be on the right side of that line for entities that are close to the line. And so you saw lots of lobbying and lots of pressure by
Mm.
various interests to try to either get themselves on the right side of the line or draw the line so that it included them. And I think yeah, that speaks to a market that does need to be just focused on rapid transition, high historical emissions, high economic activity, high economic development, levels of economic development. Uh, you have the money and you have the responsibility for all these historical emissions that are fueling a lot of climate change. So you just need to focus on green should be the priority, but
Mm.
that's not as relevant or not the most applicable position to take for largely if you look at the ASEAN market, and Singapore has the kind of financial connecting point between a lot of the ASEAN markets and
Mm.
the international capital markets. So that's, I think, why it's playing this role, um, where there's there are things that are clearly green and there are things that are clearly incompatible with transition. But there's a whole lot in between that needs to get moved in the direction of green, and you need to find a way to to create um, a market incentive for that transition. And so
Yeah.
that's what they've done with MAS taxonomy, with the ASEAN taxonomy board, the taxonomy that they've put out for ASEAN, and then some of the individual country ones. And I'd kind of be remiss here not to point out that one of the earliest ones to issue the taxonomy was Bank Negara, with the principles-based and climate change taxonomy.
Mm.
And then Indonesia issued a taxonomy,
Yeah.
I think the year before last. They're still, when you stop having just a dividing line, it's either green or it's not green, it becomes more complex. And you're seeing that play out in the interplay between national level taxonomies in ASEAN countries and then the ASEAN taxonomy. But I think that's an important process to go through, because that's going to be much more present a much more feasible path for emerging markets in general. And also, if you're looking at OIC countries, it's going to be much more of an applicable approach that can be replicated in other places. And as investors learn how to navigate these and how to understand kind of the yellow and then the phase out of yellow over time, and then also the whole push that's happening around transition plans and transition planning. Right now, mostly for non-financial companies, but transition plan task force put out sector guidance for the banking sector and the asset management sector. That's also talking about it from the perspective of the financial sector, and how do they transition plan, and how do they interact with their customers' transition planning, and how do they finance those transition plans.
Yeah.
So those are all things that are much more at an earlier stage of development than like the green bond market. And those are also the things that are most relevant and most applicable in OIC countries. And so I think I think that's why you've seen kind of a lag in terms of activity, is because OIC countries need these traffic light taxonomies, transition planning guidance, understanding kind of credible transition plans. That all needs to be in place for them to take advantage of sustainable and responsible finance
Would you
more
also
than they
say
have
that
in the
it's
past.
would you also say that it's also to do with the banking sector in a lot of these countries? So, for example, if you look at somewhere like Bangladesh or Uzbekistan, we had Odilbek Isakov, the former deputy finance minister of Uzbekistan, on a few episodes ago, and he's been influential in trying to develop the capital markets and the banking sector during his time as a deputy finance minister. Do you think that um, the finance sector needs time to develop in a lot of these countries? Because we're talking about like GCC, Malaysia, and these are quite, for OIC countries, these are quite well developed, no, compared to say like other OIC countries.
Yeah, I think that's a really important part. I think that each country has its own kind of where it got to the point that it is in terms of financial sector development, and that definitely has a consequence for when you're talking about sustainability, is kind of adding a dimension onto what is needed for different metrics of financial sector development. So Malaysia comes in as in a pretty good place because it has a long track record of being one of the largest emerging market in the capital markets space in particular. It has the experience post-Asian financial crisis of recognizing the need for a domestic capital market and really promoting that over 25 years. And that makes it unique among other emerging markets in terms of how developed and liquid its domestic bond market is. With countries like the Gulf markets, they come from a different perspective of with your financial sector development is impacted significantly if you have your currency pegged to another currency. It changes the requirements and the skills that are built up in the monetary policy sense, because you're you have that kind of imported stability
Yeah.
in terms of monetary policy, and where countries in Asia that went through the Asian financial crisis
Yeah.
um, kind of learned kind of the knife edge uh, of capital markets and open capital markets, and so had to. I mean, yeah, in a way, it's kind of you develop a little scar tissue from experiences like that build in strength into the resilience of the financial sector because you know what can go wrong and you can take steps uh, to address it. But if you haven't had that need, and particularly if you haven't had a need really to tap capital markets until recent years, um,
It's more difficult.
yeah, and I
Yeah,
think
it's more difficult to
you had
facilitate.
the most recent episode you had. That was the case, I think, within Saudi until a couple of years ago. Is that all they were doing? Debt management office was just sort of sending coupons on long ago issued bonds and wasn't active in capital markets. And so if you're not active in capital markets, then you adding on green onto that is kind of one extra step
Mm.
um, that we put on
You
the
gotta
list.
walk before
Uh,
you can run, basically.
yeah, and so it's been actually surprising to see how much of the green and sustainable issuance has come out of Saudi Arabia, given that the capital markets and particularly the external capital markets has been not not that well developed until you know
Mm.
pretty recently.
Yeah. Blake, as we bring the podcast to a close, there's two questions I wanted to ask you. The first is, we're coming off the back of COP28, which was held in the UAE in December. Needless to say, it had a lot of controversy around it. The chair and being held in a country like the UAE, which is a major oil producer and exporter, and it's home to companies like ADNOC and other players in the oil sector or hydrocarbon sector. Was COP28 a success?
Well, I think if you look at the whole process, the 28 now conferences of the parties, and particularly since 2015 with the Paris Agreement, it designed itself to not happen all in one step, but to have a ratchet each. It's referred to as the Paris ratchet. Kind of ever greater ambition is the objective in the process, and it's really the only international forum that we have for these types of negotiations. Um, there was definitely kind of a lot of back and forth towards the end between different draft statements, and whether it was they're talking about phasing out fossil fuels or completely absent on the topic, or where they eventually landed with the transition away, which I think the UNFCCC kind of described that in communications after the summit was concluded as kind of the beginning of the end of the fossil fuel era, which I think if you go back not that many years, having an international conference that came out with that conclusion would have been seen as a big step forward. I think in the context of where the ambition was that it could go, and saw that with some of the draft language that was being pushed by substantial numbers of parties to the UNFCCC, which is the countries that are negotiating or the parties to the convention. You've seen a big move forward, and it hasn't happened at at, at a single COP hasn't had the huge transformative step forward the way that the Paris Agreement did in 2015. But each one has had a few key points where progress has been made that's really important and is going to get embedded in the way that people approach the issue of climate in the future. I think
Why is it hard for countries to agree? I mean, they all know that they're facing particularly like in the Middle East. Like, I think I was reading an article, 28 out of 30 countries in the Middle East are going to be facing water stress and, desertification in some of them. Um, GCC, Iran, Iraq, North
Mhm.
Africa, these places are going to be dry in the next, say, 50 or 60 years if they don't do something.
I think it's because, and I mean, this is probably at or beyond my level of, it's definitely outside of my wheelhouse in terms of the kind of what is the kind of negotiating positions of, but I'd say, I mean, just kind of abstracting and thinking about an oil producing country that has high physical climate risk. They have two risks in one. They have both the strong transition risk and the strong uh, physical risk, but they also have a risk of, if negotiations aren't proceeding, they also have the risk that if everyone else goes in their own direction, they're going to be left facing a really complicated economic uh, market of, if there's carbon taxes that are completely divergent across countries, they're going to be facing kind of the worst of both worlds. Uh, but they're also dependent for a large proportion of their economic activity on fossil fuel production. So there's significant economic incentives in there that make it probably not feasible to take the burden, the economic hit on all themselves. And so I think that's why it's negotiation between parties, that whether they're more impacted by the physical impacts or the transition impacts or both. Um, there's definitely competing priorities in there that are hard to. There's not an easy. There's not an easy solution for how we get there, even though we all know kind of where we need to get to. You can look at the IEA's net zero by 2050 roadmap for kind of what is it we need to achieve, but kind of who pays and who finances it
But I mean, if you look
is
at it, but if you look at it, like the IEA, the UN, everyone's saying that, we're in trouble if we don't do something. But why it just seems to me countries are too interested in their own, domestic issues or interests. I think the UN Secretary General, he basically stressed at COP and before COP as well of the need to do something. And we've been hearing this for years that, then, if we don't meet 1.5% or 1.5 degrees, we're all going to be underwater in about 60 or 70 years. Um,
but we're seeing this progress happening already, even if it's insufficient, because we're the business as usual case for temperature rise is now, you were talking like 1.8, 1.9 degrees, where it was over 2.5 a few years ago. So the pace is not fast enough, but it is moving, and I think that sometimes gets lost in the process. Is It's hard and the work isn't going fast enough, but it is making an impact, um, and it's kind of, I guess, if we're talking about between now and 2050, that's generation length of time period.
I mean, it's generation, but it's not far away. 25 years is not that far away if you think about it.
It's not, and so that's why it's kind of that's why we've done so much on climate risk within RFI, is because
Mm.
of the urgency of not only doing things by 2020 by 2050, next 24 26 years, um, but also the speed at which we do it. The faster the better,
Mm.
and all of the targets of saying, if you get 1.5 degrees, uh, the impacts are moderated, but those temperature targets are still probabilistic. That's we have a dang a two-thirds chance of limiting warming to 1.5 degrees. There's lots of tipping points that we don't fully understand the science behind it, uh, that could make kind of what we think is our remaining carbon budget less than it is.
Mm.
So the risk, and I think that's where the kind of precautionary principle needs to come into play, is we know kind of our base case, which is bad, is not the worst case, and it's
Mm.
still bad. So we have to avoid even getting to that point if we can.
Great. Um, Blake, what are your future plans with RFI? Like, what's RFI going to be up to in 2024 and the next few years to help try and, drive some of this advocacy work that you guys are doing?
Yeah, so we've just been updating our strategy last year, and it focuses really on two areas, and they're all connected into the same piece, basically, which is improving the implementation capacity for financial institutions in OIC countries and in Islamic finance uh, to address ESG, climate and nature risks. Uh, and so one part of that is we have a finance emissions database where we've, for 11 countries, 206 banks across 5 years, adapted a bank methodology for finance emissions estimates, and put those out into the public sphere, and are starting to work with banks on figuring out how to tailor this data and make it useful for their own climate strategy, and capacity development internally. So that's one part. Another part we've been focused on is fintech and the role of technology in responsible finance. We announced an initiative that we're part of called the BC 100 Plus, which is the blockchain and sustainable development and sustainable finance that was uh, launched under the patronage of the 77th President of the UN General Assembly back in 2022. We've been working on the role of technology in promoting blue finance in the MENAT region. And then also the other part of our work with technology is getting fintechs to adopt responsible finance as they grow, instead of getting stuck in the position that the conventional financial kind of macro financial sector is dealing with, of having to add these capabilities on. So we've wrapped up the 6th cohort of that at the end of last year, and so we have more plans uh, for this year to continue.
Great, great. And Blake, how can people read your research or come across RFI's uh, uh, research and any kind of activity that you're doing?
We're active on Twitter and LinkedIn to follow our updates. The website rfi-foundation.org has our research, and rfi-insights.org has the open access for data on finance emissions, as well as some research we've done on what happens when you combine ESG and Sharia screens. So those are the places to go, and the strategy hasn't flowed through yet into the website, but it will shortly.
And finally, Blake, can people get hold of you? How can they contact you? Are you active on social media or?
Yeah, LinkedIn is a good place, and also Twitter. I'm at sharing risk, um, and so that's the best way to reach me. Just connect on LinkedIn, send me a message.
Great. Blake Goud, it's been a pleasure. Thanks for coming on.
Thanks for having me.